Picture this. You've just retired. You've got your gold watch. You've got your free time. Maybe you've got big plans for travel or golf. But then the market drops 30%. Suddenly you're not just worried about your next vacation. You're worried about running out of money. Today I want to talk to you about one of the most dangerous mistakes people make when entering retirement: carrying too much risk in their portfolio. We'll cover why it happens, what the consequences are, and what you can do to protect yourself. Imagine retiring in the year 2000. You had $1 million invested in the stock market. Within 3 years, that balance fell to about $600,000. That's a 40% drop right at the beginning of retirement. Now, if you're still working, you shrug it off. You're still earning, you're still buying more shares at lower prices. But in retirement, you're pulling money out every month. Those withdrawals lock in your losses. Your portfolio may never fully recover. This is called sequence of returns risk, and it's one of the most underestimated dangers in retirement planning. Okay, why do so many people enter retirement with portfolios that are too risky? Number one, recency bias. If markets have been going up for years, it feels safe to keep riding the wave. Number two, chasing returns. People remember the big years, 20-30% gains, and think they can't afford to miss out by shifting to safer assets. Number three, underestimating withdrawals. In your 40s and 50s, when you're a younger investor, a 20% drop is just a paper loss. In retirement, those losses compound with your spending. Number four, lack of planning. This is a big one. Many people just never sit down to ask, what kind of income will I need? And what level of risk can I stomach once I stop working? The bottom line is, retirement is not just about wealth accumulation anymore. It's about wealth preservation and income stability. What actually happens when you enter retirement with too much risk? Faster portfolio depletion. If you're withdrawing 4% a year, so let's say you're taking $40,000 out of that $1 million portfolio, and the market drops 30%, that $40,000 isn't just a 4% withdrawal rate anymore. Now you're effectively withdrawing 6, 7, maybe even 8% of your remaining balance. That accelerates the danger of running out of money. Psychological stress. You thought retirement was going to be relaxing. Every market dip now feels like a personal threat. That leads to panic selling, locking in losses. Another problem is reduced flexibility. If you had $1 million, but now you're down to $700,000, maybe you have to cut back on travel, gifts, or even basic living expenses. That's not the retirement most people dreamed of, and probably not the retirement you dreamed of. And here's the kicker. It doesn't take multiple downturns to derail a retirement plan. Sometimes just one really bad bear market early in retirement can change the entire trajectory of your financial future. Again, this is called sequence of returns. Let me illustrate with a simple example. Retiree A and retiree B both invest $1 million. They both average 6% returns over 25 years. The only difference? Retiree A gets the bad years at the beginning, while retiree B gets them at the end. Even though their averages are identical, retiree A could run out of money halfway through retirement, while retiree B still has plenty left at the end. That's why the timing of returns matters so much more in retirement than it does while you're still working. Remember, the goal is not to eliminate risk, it's to align your risk with your stage of life. Retirement should be about freedom. Freedom from worrying about paychecks, freedom to spend your time how you want. But entering retirement with a portfolio that's too risky can turn that freedom into fear. Markets will always go up and down. The difference is in retirement, you don't get a do-over. So protect yourself by planning ahead, by adjusting your risk, and by building a portfolio that works for you, not against you.